Hi guys, so in this video we're going to be talking about the what, the why, the who, the where, the how, and the when of forex trading. So now this is going to be a mini playlist covering the market, the players, the language, the mechanics, the tools, and the strategy. So it's going to be a 10 part, though basically will be like more of a 5 videos. Yeah, so let's get straight into the first segment. Before we do that, my name is Joseph Wambali, and we shall be basically talking about forex trading. Yeah, this is the trading archive. I'm one of the boys there. So now we shall start with the what and the why. So probably you've heard this word from somewhere, maybe some internet gurus trying to flex, flex with their big dough. Yeah, but now we're going to be talking about what actually this forex thing is. So now, forex or FX is the global decentralized market where currencies are bought, sold, and exchanged. It has no single location. Trading happens electronically over the counter, which is like OTC, 24 hours a day between banks, institutions, and individuals worldwide. So, what do we mean by that? So, this is a market. It's literally like a market where you go and buy tomatoes, onions, but basically now here the commodities that people are participating in are not tomatoes or onions. The commodities are currencies. So people actually trading currencies. People are dealing with dollars, euros, things like that. So this is a decentralized market. Decentralized means has no physical location. It's not bound to one location. It's not bound to one location. You can literally access it anywhere as long as you have internet. As long as you're connected to the internet. Yeah, so that is what qualifies it to be a market. Has products, has participants, and motives of making profits. So it has according to research, it has 9.6 trillion, which is traded per day, like daily, every 24 hours, according to current research by 2025 data. 9.6 trillion is traded daily across the whole market. The total money in transaction is about 9.6 trillion, bro. Nigga. Now, this is why you should be into this thing. That's why I put it there. So it's like a pitch, sales pitch. Anyway, yeah. So, Google fact: FX turnover jumped 28% between 2022 and 2025, the largest 3-year jump on record. What that means is that before 2022, there were low participants in the market, but the liquidity just increased, meaning it got more awareness. There's been an increase in awareness of this market, and now more and more people are jumping onto this thing. So now maybe they're thinking this is another scam or what, but these are facts. I'm literally giving you facts, researched facts on how this is not scam. This is literally a decentralized market. You get to interact with your own money. That no blows it. Yeah, so why? So that has been the what? Hope you understood the what. It's a market. Forex trading is activity, but the forex thing is called, okay, actually full name is foreign exchange. And what happens, what takes place is buying and selling of currencies. So why do traders trade this thing? Why do people actually participate in this market? Number one, because of the 9.6 trillion, but also due to the unmatched liquidity. Like, yo, 9.6 trillion, bro. What do you mean 9.6? But anyways, yeah, that is what we mean by unmatched liquidity. Traders are executing trades instantly at tight prices, bro. Remember when there's high competition, people want like when there's high competition, there's better delivery of price. Economists will know better. But there's unmatched liquidity. Reason number two, leverage and access. Now, what do we mean by leverage? Leverage is simply, let me say, is simply like debt, but it's indirect debt. It's more of a, we shall discuss leverage as we continue. But leverage is more like debt. It's like lending you money. So small capital can grow large positions. So you can enter with $100, but your $100 may be given a leverage of about one to 1,000. So by 1 to 1,000, I mean $1 is equals to 1,000 US dollars. So your $100 literally becomes that's a million, bro. So, but not like in margin. That is the money that money is considered to be. It's not the money in your account right now. It's just leveraged money or debt money that doesn't sit in your account. You understand? You just use it to open positions. Yeah, and maybe receive a profit from. So it has two opportunities: profit potential whether prices fall or rise. So depending on how you're positioned in the markets, like I said, you can either buy or sell. But unlike other markets, for example, people who invest in stocks indirectly, you maybe like buy stocks from some area of stock exchange. You're going to just like buy the thing. So when the company performs well, you do good. But when the company performs badly, bruh, you're gonna tank. So most investors only have one opportunity. They only profit in one way. Whenever things is going down, these guys are not benefiting. But this market provides an opportunity to profit in both ways. You can either buy or sell. In both ways, you're making money. And then we also have the hedging and protection. Businesses hedge international currency risk. Now, what do we mean by hedging? Hedging is literally like being against or protecting what you have. Now, when we say businesses hedge international currency risk, we're not talking about these small businesses. We're talking about businesses like Apple. Now, yeah, imagine Apple, the one that makes your iPhones. Imagine Apple wants to export its iPhones to the UK. So, to export iPhones to the UK, remember there is a difference in currencies. The wholesalers who are buying from you in the UK have to acquire those goods in dollars. I don't know if you get what I mean. So they pay you guys dollars, but now for them to pay the dollars, they need to buy the dollars. Okay, so we're still talking about hedging and protection. I was still explaining that if if we have a business, for example, your Apple, iPhones, you want to export iPhones to the UK. The people in the UK need to buy those iPhones in US dollars. So you, in order for you to have those customers, you need to have a favorable price for the dollar. So what these people actually do when we say hedging, Apple is going to let me say short. It's going to sell or go against the dollar, so that it has a what? So that it has a smaller or a lower price. So what these guys will do, they will sell the dollar so that it has a smaller price, therefore enabling their customers to buy the dollar and buy their commodities. So that's what we mean by hedging. Hedging against or protection. Yeah, so that's what those businesses do. They don't directly interact with the market as in buy, sell, buy, buy. Now they just hedge against certain currencies that they feel like will go in their favor. Yeah. Yeah. I think basically that's it. We shall talk about other things in the next video. This has only been what Forex is and why you should be participating in this market. Peace. You. See you in the next video. Make sure to make a comment down below what you've not understood, what you want me to explain a little bit more, or maybe give a like, thumbs up.